I'll start the talk by doing what I usually like to do, which is talk about the economy and see if the market's overvalued. Well, how do we know that, Cecil? How do we know whether the market's overvalued? Well, what they do is they use something called P over E, just a ratio. And P represents price and E represents earnings. So all that means, ladies and gentlemen, is that if a company's trading at $100 a share and their earnings per share are $10, then we can see that their PE is 100 over 10. And if you reduce that down, it's 10. So if they say that the average stock market is overvalued at 19, is fairly valued at 16, and is undervalued at 13, then where are we right now? Well, we're just right about average. We're a little bit over 16. So from a valuation point of view, and that's if you take, that's if you take all the stocks in the S&P 500 and average their price over their earnings. It's a little bit over 16. So what we're saying is that the economy and where the market is trading from buying and selling stocks and fair valuations of Apple and Exxon and Tesla and all these stocks, we're about average. So the market is not overvalued. That's what the economy is saying. So going forward, markets look pretty good. Also, the markets are trading at record earnings. In other words, go to the mall. Has anybody been to the mall lately, Jeannie? Has anybody tried to get a parking spot at the mall, especially on Saturdays or Sundays? People are buying. People are spending. And guess what? 70% of the market is driven by you guys getting out and buying stuff. So to make a long story short, we've got record profits. Profit margins are record highs. Net earnings revisions are good. From an economic point of view, from an intuitive point of view, the numbers look really good. Now, there's a couple of things that happened. Donald Trump put in a tax cut in 2018 and gave about $1.8 trillion of tax breaks to the super rich. And that means the owners of corporations. And what they did was they started buying back their shares of stock. And what that did was it made earnings go up. And so that's how much buybacks there were last year. And this is the buybacks this year. So it's starting to rise to match last year. So share buybacks make stocks rise. So that's not a bad thing either. And I think the Trump tax cuts did help the market. It did give it an adrenaline shot. As I said before, 70% of the economy is you guys, the consumer. That's why I said as goes the consumer, goes the economy. The GDP, the economy is above average. So when you look at these numbers, and now this is interesting, look at household debt. It's at an all-time low. And look at household net worth. It's at an all-time high. So Patty, from a point of view as the average person in this room, is doing pretty well. I mean, if you say that this was a cross-section of the country, things look good. Things look good. So the deficits aren't good, but we're still not as high as we were after World War II. We were about 110, 120% debt to GDP. Right now, we're about 85, 90% debt to GDP. So we're higher than we've ever been other than World War II. And that's not good, but that's not terrible. Inflation, interest rates are really bottoming. And inflation, the government says there's no inflation. Do you believe them? No. Okay. In fact, here's the CPI's Consumer Price Index. Now, all inflation means, Leonard, all inflation is how your money depreciates every year. So $1 a year from now might only buy 97 cents next year if inflation was 3%. And that buying power means that you have to have more money to live the same. Well, they're telling me that I have almost no inflation. And unemployment is like bottoming out. I mean, is at record lows. Unemployment is the gray line, and wage growth is the blue line. So we really haven't seen wage growth come up as much as we would like, because look at the wages up in here. Look at the wages up in the early 80s. They were really good. Then they kind of crashed, and they've kind of bounced, but they really haven't been able to. And you could see with this drop in unemployment, wages should rise, because as there's less workers, they should get raises. So why is the news so negative? I mean, there's a lot of fear out there. The pessimistic levels are at all-time highs. People are very scared because the media basically says if it bleeds, it leads. Media is in the business of selling fear. Now, let's face it, these shootings are scaring everybody. But when it comes to the market, they're just basically tons of articles about how the markets are, heading for a 1929 crash. Fox News is known to sell fear. So that's what a lot of it is what's going on. But let me just say a couple things. Number one, Warren Buffett is known by saying, when fear is high, I want to buy the market. And when fear is low, I want to sell the market. In other words, people tend to be 100% wrong about. In other words, people tend to get in when everything's great, markets that are high, and they tend to get out when markets are crashing or crashed. So people always sell at the bottom and they always buy at the top. And that's what he's saying. But are there some things we should worry about? Yeah, there is. One of the things we should worry about is the tariffs. Now, Donald Trump's not stupid. If he wants to get reelected, he's got to figure this out. Because the tariffs will destroy the economy. It will destroy the economy. The tariffs will kick this global economy in the butt. And if that happens, then we've got a downturn coming. But we're a tweet away from the market being at an all-time high, too. So that's the problem. Jack, you were saying, well, how do you invest in this market, Dom? How do you manage money when it's going up 5%, down 5% every week? I mean, how do you manage people's money? Well, that's what Monty's going to talk about in a minute. And I'm going to talk a little bit about. But anyway, I believe that Trump, with his advisors, Larry Kudlow, his economic advisor, is going to say, listen, Mr. President, work it out with China because global tariffs aren't good for anybody. They're not good for China. They're not good for us. They're not good for anybody. The last time we had trade wars was in the 1930s, and it destroyed the global economy. And we stayed in a recession a lot longer than we should have. And that's not good. That's bad. So this could derail the whole market. This could be the Achilles heel. Now, I love this quote. Favorite quote, ignorance is not the absence of knowledge, it's the illusion of knowledge. Is that, does the government lie about the numbers? And guess what? The government does lie. If we use the inflation formula that they used back in the 80s, inflation would be just under 10%. So why are they changing the numbers, Jeannie? Why are they changing the numbers? Well, your Social Security is tied to what? It's tied to that. So if inflation rate is high, guess what? You get a bigger raise, and the government has to pay out more in Social Security. If inflation is low, then you get a lower raise every year. Does that make sense? So really, it's kind of interesting how the government says, oh, no, inflation, there's no inflation. Well, I don't know, but Carol, I go shopping. Does it look like there's no inflation to you? I think there's inflation. I'm sorry. And they took out housing. They took out housing out of inflation. How could you take out housing? How could you do that? I mean, that's like our number one asset, and they took it out. They're saying, oh, there's no inflation. Let's just get rid of housing. And when they got rid of housing, it came down here. Also, if you increase the CPI, then that means that the GDP goes negative. So that means we're running at a negative gross domestic product. Now, here's what's another interesting one. They changed how they calculate unemployment. They used to calculate unemployment as if you were looking for a job and then you stopped looking, you would still be considered unemployed. Now, if you look for a job and you stop looking, they say, oh, you're no longer unemployed. So if they kept the old formula, unemployment would be about 22%. Okay. So here's the problem. If I'm going to use an approach that says I'm going to look at the economy and make decisions about my portfolio based on the economy, but if they lie about the data, then if the data is not good, then you're making decisions on the wrong data. Does that make sense? And as a firm that's built on data, that's what a quant does, I can't use the intuitive approach. I just can't do it. A couple other interesting slides. We are in the longest bull market in history. We just surpassed the second longest. The average bull market lasts 48 months. We're 120 months. Now, I don't believe that bull markets have anything to do with time. It has to do with economic shocks. 2008 was an economic shock. It was deregulation, and it was a massive misappropriation of the mortgage industry. 2000 was a dot-com bubble. things got way overvalued. So when is this bull market going to end? It's when we have an economic shock. And it could be the tariffs. It could be a war with Iran, which would not be a good thing, and the Straits of Hormuz. So, it could be China and Hong Kong. God, I don't know. I mean, Hong Kong's a big economy. So the intuitive approach, I got a problem with it because I don't believe in the numbers. That's bad. Okay, so let's talk about diversification versus hedging.